Hey guys, and welcome to another video. My name is Dan, and today we are going to be discussing how to look for and identify advantaged trade locations. What I mean by that is areas in which we can find ourselves with a low risk to a high reward potential before we know whether or not our trade is valid. Beyond that, we're also going to be discussing how we can use information on the chart with nothing more really than just the price action candles and our volume chart to read price action and kind of give us an idea of where the market may be moving to, where it may be going, where potential turnaround spots may be, things of that in that nature. As always, guys, if you like the video, please like, subscribe. Every little bit helps. And as always, you can join us in our Discord. You can trade right alongside me in the mornings, and it's free. But anyways, guys, I'm going to try and not ramble too much today. For those of you who've been watching a few of my videos, you know that I do tend to get long-winded. So we're going to try and speed through this first part here and just kind of retouch on a lot of the concepts that we've already covered in previous videos, because we do need to have that understanding of auction theory and what we're looking for before some of what we're going to talk about actually starts to make sense. All right. So jumping right into it, auction theory, right? So what drives price action? What drives market action? There is a tug of war that is constantly going on between buyers and sellers. And the market tends to go into this balancing and unbalancing phase. So what ends up happening is as the buyers and the sellers are battling it out, when they're pretty evenly matched, or when they keep kind of giving power back and forth to each other, we get these balancing areas. And oftentimes we'll see these, or we'll refer to them in a day time frame, week time frame, or intraday as consolidation areas. Now, as soon as one side gets the upper hand and they tip the scales from balance to imbalance, that's when we get movement, right? That's when we get breakouts. That's when we see the consolidation stop consolidating and it begins to make a new move. Beyond that, let's see, we've talked the market cycles. We've got the consolidation and we have movement. So that's the difference between balance and unbalance. What this creates is it creates our zones for supply and demand. Whenever we move out of balance, we're looking for a new balance area, right? So when buyers are in control, they are pushing price up and they are buying up until they hit a point at which no one else is interested in buying, or they hit a point at which sellers start to then show up in force because now they're seeing this price as an advantage price to short or to sell. All right. So that's the basics of where we're starting from. That's what you need to understand before we start moving into what's next. So with all of this, when we have this balance area and this unbalance area, we create support and resistance. If you're this far along in the videos, you should already know what these things are. Support, of course, being when price moves down to a level in which sellers are unable to push it lower. Resistance being the same but opposite. As buyers push price up, they're no longer able to garner support above that point, or sellers are stepping in to sell. We have our supply, sellers, and our demand, buyers. Now, with all this, we create our support, we create our resistance, channels will form. Channels can angle up, channels can angle down. We also get apexes, which is when price action starts to condense more and more and more, which starts to show us that the buyers and the sellers are starting to reach a focal point, or a fulcrum, if you will, in which the price is so agreed upon that the market is finally getting ready to make a big move in one direction or the other, because it can only trade sideways for so long. Granted, so long can be a long time. So we're going to look at our chart here, and the first thing we're going to do is I'm going to kind of take you through my process and how I read the intraday action and I start to determine where my channels are, where my support is, where my resistance is. And I'm also going to point out when we're in our consolidation areas and when the market is moving. So this is our 1-minute chart. This was from Friday. There's some pretty good examples of everything that I'm talking about right here in this chart. So we're going to go ahead and use this one. I do want to preface, of course, that not every day is going to have the same types of patterns. Some days you may have one long channel going in a direction the whole way. You may have some days that never actually end up forming a channel. You may have days that just completely balance and days that are completely unbalanced and end up moving all the way in one direction. So as we opened up Friday morning, the first thing we can see is, the first, 8 minutes of market open, we can see this back and forth between buyers and sellers. So right here at our open point, we have our first bit of consolidation. It only lasted 7 minutes, but we can see that finally the buyers were able to tip the balance away from this consolidation area, and we had this movement upward. We're going to actually zoom in on this a little bit more, just so that way we can see what we're talking about just a little bit easier. Okay, so we've got our consolidation, buyers tip the scales, and we start moving up. Sellers attempt to push us back down, but as we can see, the selling stopped short of where we were building our first resistance. So just to help you kind of see that, we're going to draw just a little square in here to illustrate that. So here's our consolidation area. We've got the up and down, we've got our support down below, our resistance up above. As we get further along in the day, I'm actually going to put lines across the chart to illustrate this better, but I just wanted to use this to kind of show you real quick. So buyers tip the scale, we move up, sellers attempt to push back down. They now find that the old resistance has now become a support, in which this garners more buying, and we try to jump up another level. But as soon as we come up to our 200 moving average, as well as our 48 moving average, buyers are unable to garner support higher than that. Also happens to tip out right at our VWAP plus 3, which is 3 standard deviations away from the volume weighted average price. And because buyers could no longer garner that support, or because this price point was now seen as advantageous to sellers, we see the selling start to begin. And first it comes down to test, and we eventually push with this next bar right back into this first consolidation zone. So what I want to point out with this, whenever we have these large jumps in price action, and we can see by our volume that there really isn't anything special about these volume bars, right? They're not really that much higher than what's going on. They're just kind of average. So what that tells us is that this type of demand is pretty average, right? It's just an absence of selling. I mean, we can kind of look down and we can see, because we use the Welkin bars, we can see that there's just a teeny tiny bit of selling in this nice big bar. And then on this other one that's probably about a third larger than this one, maybe, there's no selling whatsoever to be found. It's just one big green bar. When the buying dries up, we can see in our next subsequent bars, there is no buying. Sellers push us back into this consolidation area. We move back across VWAP. That tends to be a big signal for folks who are waiting for the shorting opportunity. They pile in on top of everybody else who started shorting from up here, and suddenly our supply has now flooded this old zone. And as this zone becomes flooded with supply, it pushes us all the way through to the next one. So right here, we've got some pretty big ignition candles lining us all the way down. And we have now flooded our consolidation zone with supply, and we've dropped ourselves down to this new level. If we kind of extend this zone out a bit, we can see that we have literally dropped right below this previous level. So now we're entering into a new area in which buyers and sellers are starting to consolidate, right? We've got this push-pull, this little tug-of-war going on. And what we're going to get into a little bit later is this is going to be a really good example of identifying what we call accumulation or distribution campaigns when sellers and buyers are fighting it out, to help us get an idea of where we're going to be able to place our trade to have the best odds. But before we get to that, let's finish this cookie before we open up into the next one. So we've got our push-pull, we've got our balance zone starting to create. We can see that it's starting to gather more push towards the upside. We have these two candles right here completely reclaim this entire supply drop. Finally, with another little balance zone happening, which has a support that is higher than the previous one. And finally, we get our next buying push back into the previous consolidation zone. And we can see that most of that supply was already scooped up. And so this just kind of picks off the rest of it. And now there is no supply left. So suddenly our demand skyrockets as everybody piles in. And we come into a very large volume bar to signify the end of our move upward. From that move, we enter into another consolidation area, but this one we can see takes on a slightly different shape, right? So this is where we actually start to get our first channel forming. Come here, come on. Nope, we're going to do this from the bottom of this, okay? So we had our move, then we had our channel form. We're going to draw our support and resistances from what was going on earlier in the day. Make those a little bit larger so they're easier to see. There we go. All right. Oh, this is another important one. We're going to go ahead and put a little line there as well. Oh, that up move wasn't done yet. That's the end of the up move. So when we're trying to gauge where to draw our support and resistances, what I like to do is I wait for these swings, all right? So here's our first consolidation zone. We've got our resistance, form that off our first bar. We've got our support, form that off of our second bar. When we finally finished this consolidation, we broke up through, right? So our first swing up would be where we peaked out after the move was done, which then means our first swing down would be where this move finally finished before we started our next consolidation area. So that's why we've got our support here and not down here. All right, now same thing kind of happens when we're moving back up into our next area. As we move up and through, we're still not quite done moving up. It really isn't until we hit here that we start to kind of get that pushback, that back move. So to be completely honest, we could actually even insist that this has a little bit more to go, especially because we didn't then start the next down move till we got to there. But the reason that I decided this one was important enough to put in is because, as we can kind of see as things went along to the right, this became important, as did this. Now, from an intraday perspective, one of the things that we have to remember, especially when we're doing post-analysis of a chart, right? You're not going to have all this information to the right when you're drawing this. So, for example, as we started out, we would have had these two right off the bat. We would have had this one right off the bat, and we would have had this one right off the bat. It wouldn't have been until we got really up to here, we probably would have drawn this, and this wouldn't have quite been a line that we would have put in yet. So one of the things I'm going to do to help kind of differentiate that or break that down is we're going to go ahead and put a check line through that, because we don't know that that's important yet, at least not from where we're anticipating activity and action. So as soon as we start coming down here, we make our next swing low. This would potentially be where we would have our next support. But here's the thing. We've already got one right down here from the last resistance. So the reason we don't give ourselves another support line here is because what this tells us with our support and our resistance is that as sellers were pushing back down, they didn't have the strength to push the price back down to test the old support. So we don't have to put a new one in because this one is still holding. This one is still valid. So as soon as we start breaking up and we come up through here and we get our retest, we can see now this is suddenly where this is going to start to look a little bit more important. We've got this almost consolidating like activity snaking around this point where the first buy move started to lose a little bit of steam. So that's probably the point that we could decide, all right, well, maybe we will mark this off just because, we've got these supports that are coming down to it and aren't quite going by it. We get this further push up. Now we've actually we have a we have an upward channel that we can draw. So it would be at about this point is when we would draw our channel, and we can start to see that price activity supports are raising, our resistances are getting higher. So the bottom of our channel becomes our support line, and the top of our channel becomes our resistance line. But we can see as soon as we go to make this peak, we don't quite come up to the resistance anymore. And then the next time we try to swing up, we still can't quite clear that zone. We start moving through, we break through the channel, and we go down to test this support, which we hadn't tested previously. Following a move attempting to push back into the channel, can't quite find that. So we see that the weakness starts to push us back through that support, and eventually we get a swing through our 200, a last-ditch effort and attempt to push us back up. There is no longer demand being found up above this line. We start to fall down again. We can see that now we're starting to drop our support levels all the way back down to where we test the original resistance and support. But as soon as we go to test it, we don't stop there. We can look down here and we can see that the volume's starting to build towards the selling. And as soon as we break through that and we get that weak attempt to push back up through, probably a spot that we could short, right? Coming back through, we can see that now this next zone can't seem to hold action either, can't garner that demand to push us back up, and we drop through again, all the way back to our original level. But from our original level, we can see we tried to break back through that resistance once. They tried to break the support, could not break the support. It ends up holding. We get the push up through, another test down, support is starting to rise, and then we push back up to consolidate again in this zone, and then eventually so on and so forth, we keep on moving. Now, another thing that we can see here is that as soon as we did make that break, we started to get another channel forming. Right? Cool. Okay. So now we've got enough lines on here that we can start to look at this and we can start to say, okay, so where are our advantaged trade locations? Okay, so this is what the video was going to be about, right? I know it took us like 20 minutes to get here, but bear with me because now this is totally going to make sense and you're going to see this hopefully in a completely different light. And what I want to do is I want to try and take this one step at a time and really focus towards just what we can see on the chart as we're getting to a point where we could potentially be making a trade, okay? So as we open up, we get our resistance, we get our support right out of the gate. Now, whether you are a breakaway trader or you are somebody who's simply trying to short the resistance or go long on the support, what you can start to see by drawing out these lines as you make them is that there's going to be advantage locations. So for example, we get our breakaway from our first consolidation zone and we get our pullback, but the pullback is unable to completely undo this push. So at this point, when this green candle starts and we push back above that resistance, this would be a really good spot, or at least a really good risk to reward spot for us to go long. We've already broken the resistance, so we've proved that it is a weak zone. They attempted to bring us back to consolidation to no avail. So if we go long, as soon as we get back above this point, and of course recognize that we want to cover the position if it falls back below this, we should have a pretty good risk to reward. We can risk just a teeny tiny bit, and our reward is going to be anything that results from this move. So this being so early in the morning, this is probably something that you'd want to treat a little bit more like a scalp, provided, of course, that price action doesn't just take off like a rocket ship and keep going. So let's say, for example, we did go long on this re-break above the resistance. We would ride this up, and as soon as we hit here and made this resistance and this pullback, we would have to make a decision. We could continue to hold this position, and we would have a chance to hold it through here and seeing whether or not we were going to test that resistance again. And then when we get this big red candle and we get a pullback almost all the way back to right where we would have entered. So at this point, if we haven't protected our profits with a stop loss and then naturally got kicked out on this candle, we would then want to look at our next candle as we popped up. This is the one that we would take our profit on if we didn't have our stop loss. Because as this moves up and it can't get back above the ignition point of this candle, that's a lost cause. We want to get out of this and we want to wait for our next position. Now, as this continues to come through, we see that we do end up breaking back through, and we can see that this comes all the way down to completely undo this zone. So at that point, we're now back into our consolidation area. On this next candle, as we pull back up to the resistance and fail to break up through it, this is the perfect spot to go short at that resistance point. We can then cover it if price action does end up going above this line for a very small risk, or we can hold it to see if we're going to get a full-on test of our support level. So we go short at this retest. It plays down, comes on through. Once it's broken through, we don't have to cover this position yet. We can hold on to this. It drops further. Now we start to find that we're hitting some consolidation. We've got 2 touches of support. So at this point, we have a choice to make. We can cover this position and take our profits since we made it to a new level, or we can continue to hold it and we can use this line as our bail line, because even if price action breaks back above this new resistance line, well, we entered way up here. So we're still going to be securing our profit. But now here's where some very interesting information is going to come into play. And this also touches into what I wanted to talk about reading price action. So as we're in our new consolidation area, what I want you to notice is that we get this ditching push that actually breaks the average amount of volume all the way down and is immediately pushed back into our consolidation zone. This is what we would refer to as a textbook spring event. It is a push below the support that absolutely goes nowhere. There's no follow through. It gets nothing. At this point, when we push back up through, it would be in our favor, in good odds, to go ahead and cover this position and not even wait for it to break back up to this level. That being said, on a spring event such as this also gives us another new location that is very good risk to reward for entering long. As soon as we spring back through this, we can enter at this support line, and if we break back through, we cover. But as we can see from this, so let's say we covered our short position from up here, we made a nice profit, and now we're riding long on this same spring. We come up, we come back down, we can see that the support is now rising. This should give us a little bit more security, and we can go ahead at this point and we can move our stop loss right up to here. So that way, even if everything just kind of breaks down, we're going to get stopped out of this long position and take some profit. Might not be a lot, but at least we're in a good trade location, so we can do something like that. But of course, on Friday, that wasn't the case. We did end up breaking up and through. As soon as we break through this, we can see that they can't push it back through. We can hold on to our long position. No reason to get out of it. We're blasting up and through. We're still in that long position. Well, now we're starting to get into this point where we have this pullback all the way. Still, support has held. We could hang on to our position. We don't have to get rid of this yet. Coming back up and through, we see another thrust through this resistance. This would be a new resistance. We see another thrust through resistance. However, this one definitely falls short. That being said, what we've now witnessed here is a shortening of the thrust, all right? From here to here, this was 389.35 to 389.83. So just kind of rounding, we're going to call that about 50 cents, right? So then from 389.83, we move up to 390.34. So again, we've got about a 50-cent jump. Not great, but at least we're not shortening yet. But as soon as we come up to this one and we don't quite make it to that resistance line, we'll now look at our thrust. 390.34 to 390.64. That's a 30-cent upward movement. So as soon as we get this next movement that fails to bring us up higher, we have a shortening of the thrust. And that right there in reading price action tells us that the probability of a turnaround, the probability of losing these levels is starting to increase. Buying is no longer getting as much drive upward as it was before. And sure enough, if we decided to cover our long position right around here, we're going to make a nice chunk of profit, and we're not going to be caught out when eventually this starts coming back down, right? We could keep holding it, and the market would give us a few more opportunities to take some pretty nice profit. But at this point, once we've broken through that channel, this upward trajectory is no longer valid, right? These levels, they're going to be tested. We can't get higher. The resistances are falling with each subsequent drop. So this is the market, giving you your opportunity. It's saying, hey, get out of your long position. So let's say we did cover at the best spot. Well, as soon as we break through our upward trajectory, the next thing that we see by price action is we can now say that the tone is changing. We had a very bullish tone take over from probably right about here where we had our spring till just about here where our thrust shortened. So at this point, the tone of the day is changing. Buyers, bulls, they're not in as much control as they were at the earlier portions. And now we can go ahead and we can take a short position using our channel as our decider. So as soon as we break through here and come back up through, we're not able to get back into the channel. If we were, we could potentially look at this as a spring event. However, the probability, the odds start to significantly decrease of a spring happening with this channel because we have a shortening of the thrust. If, on the other hand, this did come all the way up to our resistance and we were continuing on our same thrust trajectory, a break move like that could be signaling us for a spring. But in this case, we get the push back up to the channel. We don't secure a spring. So at that point, we can go ahead and go short, which our risk to reward is if it pops back into the channel, we get out of the trade. Otherwise, we end up holding ourselves short. Now, as soon as we get this drop through, when we do break back up through, this would be a tricky trade, right? We could take the profit on the big drop, try and scalp it, and we could see that we're not able to break the 200, and we could determine that that's a good spot to take our short, or we could hang on to it. And now the thing that we would run into is that, yes, this peak right here, it's just about where our entry location would be. We take into account the theta that would have happened between there and then. This is if we're options trading. So at this point, this peak is going to look pretty close to break even for us. So if we're still holding on to this trade, we definitely don't want to hold it any longer than where this resistance would be, right? So if all of a sudden this peak did come up and break through here, we would have to take the full loss on this position because that would be another change in tone. That would be an attempt of bears to change the direction and their loss. They would not be able to. Bulls would have been taken back over, and that would have been our signal right there that if nothing else, we would at least be entering into a consolidation zone, and we should probably hang out and wait before trying to take our next trade. But it didn't, right? We can see that we broke through a resistance, and we didn't come up to that old point. So at this point, this becomes an upthrust, which is the opposite of a spring. An upthrust is when the buyers are attempting to retake control, and when they break a critical level, there's no follow-through. Similar to when sellers, they try to break a critical support, there's no follow-through, buyers take advantage. Well, here, buyers try to break that resistance, no follow-through, sellers take advantage, sellers take advantage, sellers take advantage. So if we were still holding this short position, we could continue to hold it, right? And at this point, there's nothing that gives us any danger. And we start to see that now we have a downward channel that we can be playing to, okay? But as we start to play this downward channel, we notice that something similar is happening at the bottom of this downward channel, which also happens to be, again, our first consolidation zone, we had the shortening of the thrust to the upside. Well, now we've got boom, that's a big move. That's a shallower move. That's an even shallower move. We have a shortening of the thrust to the downside. And now we're no longer coming anywhere near the low of the channel. As well, here's something else to point out, guys. We have another spring event. Now remember, all of these lines that we're playing to at this point, we drew these lines early in the day, right? We had all of these lines drawn and ready to go at 10:38 a.m. And now we're making plays out here in the middle of the day based on things that we had drawn earlier in the day. Because the market is giving us that information. It's showing us where the levels are. It's showing us where there's pockets of supply and where there's pockets of demand. And when we can read that from the chart, from the price action, that's what's going to help us identify where our ideal trade locations are going to be. So we get this new spring event, we can go long again. We get that break. So at this point, we probably would have gotten out of this position just because we've gotten much later in the day. We're not sure if the tone is changing again. And we can see that there really wasn't any follow through through that critical level. But let's say we didn't fully cover the position and we kept holding. Well, when it falls back through, we can see now that our support has absolutely risen, right? So here's the support we kind of made in this consolidation area, right here where my crosshair is. And now we've got this big gap between that support and now where this support would be. So we could keep holding that position. We now see that we've come back up to our VWAP. We've come back to our 200. Support is still rising. We can keep holding that long position. Support is still rising. We can keep holding that long position, and so on and so forth. So we are not going to go through the rest of this chart. I mean, this goes all the way to 145. There would be plenty of other examples. But what I really want to show you guys is, again, by making sure we're present in the morning, and we could even sit out for the first hour, right? Because, I mean, we got our last line realistically at 10:30. So we could sit out for the first hour, not place any bets on these unless we saw something that we liked. And then we could place the rest of our bets on the day just based on whether or not these lines hold or not. And what we're looking for. So this is where our reading of the price action really comes in. When it comes to support and resistance lines, we're looking for breaks that have follow through to support our theory. That can be to both sides. So a break of resistance needs to have follow through. Break of support needs to have follow through. And when they don't have follow through, that's when we find that we tend to get our reversal points. And that's just for our support and resistance. Okay? When we have channels start to form, it's the shortening of the thrust in either direction that starts to show us where our potential reversal points are. But when we have channels that are also syncing up with old support levels or old resistance levels, we can almost get an even higher probability to make sure that we're on the right side of the trade. Now, again, we are looking at this in hindsight, right? So obviously, I know where all the good trades are because I can see the rest of the chart and everything else that happened. But what I want you to understand is how I'm explaining this. We take the entry based on what we can see immediately, and that's what makes it an advantaged trade location. Let's come back to this spring, for example. If this broke back down and came back through this support level, well, we entered here, and we're going to exit just below it. So we're really risking just a very small amount. Now, we don't want to just enter arbitrarily at a resistance, at a support. You can play like that, but you're going to end up also losing quite a bit. So what really we're looking for is we're looking for those edges, right? We're looking for those tells, those little things that the market gives us to help us know, okay, in this consolidation zone, should I be looking for a short? Should I be looking for a long? Well, let's look at the price action a little bit more. We already talked about our springs. We talked about our up thrusts, spring again. So those are two really good things that you can use to give you an edge for placing a bet when it comes to support and resistance. We talked about shortening of the thrust, which will help you whenever you're able to identify channels for placing your bets. But The next thing we want to look at is how volume can also give us some signs or give us some tells. So let's look at this zone right here. I think this one had some really good examples. I remember from Friday morning we were discussing the entirety of this play with everybody who was in the chat, and this ended up being a great one. I took a long position off of this spring, and I ended up riding it to about here. Yeah, so I took my first piece as soon as we broke through. Trying to remember specifically. First piece was taken when we hit this exhaustion point. I remember when I saw this big volume candle, I decided to take a piece, and I'm going to tell you why. So when we're talking about reading price action, right? When you get a surge of volume like that after a move has already happened, this tends to be what we call an exhaustion. And by that, what I mean is just everybody else dogpiled in. The last of the last got into the move, and then that was it. There was nobody else looking to buy at that point. You can also see that over here with this selling spike, right? You see how that volume just comes way up above. That was that last ditch effort, that real big push down that then resulted in a reversal. Pardon me. So the reason I sold a piece of my long position off of this is very well demonstrated right over here. That can sometimes be, and actually I shouldn't say sometimes, that oftentimes is a sign of reversal. I don't think, unless there was something giving me a reason, like a support or a resistance, to play a reversal such as that. This actually might have been a good one because we can see that we didn't quite make it to the support. But up here, right, we didn't have any of these lines yet. We were flying blind. So that's a good reason for me to take the profit. There's nothing that tells me I should go short here. There's nothing that tells me I should continue holding long here. So I took a piece and I waited. Sure enough, when I saw this, I held on to the rest of it. I didn't get rid of it. When we came up here and I was starting to measure the thrusts, I had noticed that it was starting to shorten. And by the time we came back down to here, I actually had adjusted my stop losses up high enough that it was this final dip right here that did kick me out of the last of my position. Unfortunately, you can see by this that there was another move up after that, but you're going to have to make those judgment calls, right? I had already made profit all the way down here to up here, then to what was going on up here. So this wasn't a bad spot to take my profit. That was great. It was a good day. We love when we have days like that because, well, we're not always going to have days like that. Losing my train of thought just a little bit. Okay, so we've got the peaking volume. Peaking volume can be the signal for a reversal, or it can be the end of a move. Now, one thing you have to be careful of with peaking volume, and I really want to make sure I touch on this because I don't want you to just, see a huge volume bar and think, oh my gosh, I have to play the reversal here. Well, let's say this huge volume bar was on a break. Unfortunately, there aren't any real good examples of that in our current chart. But when you get a really big volume bar, that initiates a move. So if we're in consolidation like this, and then this bar right here, if this bar was as large as this bar, I wouldn't try and play the break of this resistance level as a reversal, right? Because if there's a huge initiating amount of volume from a consolidation, that's going to be the opposite. That is almost going to, or that's going to be your flag that the move is about to get going. Because what that tells us is a big order started that move, as opposed to a big order or a lot of orders finishing that move. All right, so I know that was a lot. So let's recap real quick on volume peaking. At the end of a move can generally be regarded as exhaustion. At the beginning of a move can generally be regarded as initiation. So don't play the reversal on initiation, but look for good signs that a reversal on the ending move could potentially be to your favor. And again, you want to use good risk to reward locations, right? So let's talk about this one right here. This one had pretty good risk to reward location. When we got this big red volume bar back down, without that follow through down to the support, we could enter long on this next candle. We would have to take a little bit more risk, right? Because we would probably play to this support level as our risk level. Either that or we'd play immediately below the low of this red candle or this initiating candle. So that would be our choice there. If we decided to enter long on this candle, we'd take a little bit more risk than some of the other plays that we've seen. But still, there is the potential for a reversal off of a move like that. So you'll have to weigh your risk to reward and what you would have to actually put down to see if your trade idea is correct. So the last thing, or no, there's two more things that I want to talk about when it comes to reading price action, movement, and volume. So let's talk about effort versus reward. Now, effort versus reward. Your volume bar is going to show you the amount of effort put into the same candlestick or the same price action bar. The price action bar is going to show you how much reward came from that effort. So for example, let's look at this drop through supply. This looks pretty aggressive and crazy, right? I mean, look at this. This is a huge drop. We can see that very little effort was actually put into this, right? Because it was only really hitting our average volume. So a ton of effort was not put into this price job, this supply zone that was created. But what I also want you to then recognize is look at the size of this buying candle. The price range on this is all the way from our support at 385.91 up to a high of 386.43. This covers half, right? Half of this entire zone. Look at the size of this candle. Look at the size of this candle. They are almost the same size. Now look at the volume that corresponds with that. This barely even comes up to our average volume versus this big candle that goes way over our average volume. So we can look at that right there and we can say, wow, would you look at that? Barely any effort was put in to buying supply at this level. But look at how much reward came from that buying. So right there, that is clue number one that what we are seeing is a divergence. A divergence is when the volume bar and the price action bar are not the same size. You can have tiny volume, big price action bar, or you can have huge volume and tiny price action bar, and that's going to be a divergence. So if there's a ton of volume, there's a lot of effort. If there's a little price action bar, there's barely any reward for all of that effort. And vice versa. If there's this tiny volume bar, but a huge price bar, that's very little effort for a lot of reward. So at this point, that's our first sign that the bulls are potentially, and I say potentially, they're probably doing what's known as an accumulation campaign. They are accumulating all of the supply that was flushed out in this zone. And how do we know that? We don't know for certain, but we've got our little context clue that they didn't have to try very hard to scoop up here to here. All right, so that's our first signal. Support's not breaking after these three tests. We get a spring event. Second signal that we're looking at an accumulation campaign. All right, we're getting this buildup, giant green bar, slightly lower than average. That's another huge sign, right? Because again, look at how much volume was put into these bars that dropped us down versus how much volume is now pushing us all the way back up. It has now taken less volume to get from the bottom back to the top than it took to bring us from here all the way down to here. So that right there is very telling. That right there is very telling that the amount of effort that is going to be needed to push us into the next consolidation zone is not as much as it took to push us down. That is a bullish divergence and argument. Sure enough, it did end up panning out that way. We pushed up and through, and we continued to push up and through till we got this. And then finally, that was where we got another divergence, right? So we can see this volume bar right here. This is above average. This is a pretty big volume bar. But now look at this price action bar. From top to bottom, that really doesn't match, right? That's not much. It's tiny compared to how much volume we're seeing. Then, of course, we can see in the next one as well, big volume, tiny, tiny bar. So again, when I said to you guys earlier, I decided to sell a piece of my long here. Well, not only did we get this huge spike of volume, which could be a potential reversal, we're also starting to see divergences that are showing that a lot of effort is being put in, but we're not moving higher. We're not getting these big price jumps. A lot of effort, little reward. So that could also be an opportunity for the bears to hop back in. Okay. Well, guys, I think I have about exhausted what we're going to get through today with this particular topic, and we've covered about 45 minutes, so I definitely don't want to make this video any longer than that. We definitely will cover more videos like this in the future, especially when I run into other days where there's just really, really good examples that we can draw from, where I can show you guys where there's advantage trade locations and where the price action, gives us these very, very clear signals in the divergence between our volume and our price action bars. Because at the end of the day, guys, that's really what we're looking for. We're looking for the advantage location where we can put very little risk to very high reward. And we're looking to increase our probability by trying to guess what game is being played by the big boys based on what we're seeing in the price action bars as they relate to the volume bars. And what I really want you to understand about that, about price action reading, about support, resistance, do you see how many indicators are on my chart? We have volume, we have moving averages, and that's it. There aren't more indicators. There's no RSI, there's no MACD, there's none of that. Because here's the thing about indicators. They're only going to aggregate information that has already happened. But to actually place a trade, we're making a bet on what's going to happen, not what has already happened. I mean, that's old news. That's done with. The most relevant information is going to be the most immediate bar to the right. Now, of course, if you have great success trading with certain indicators, or if you have a system that requires you to enter and exit whenever an indicator tells you, if that works for you, power to you. I'm not here to tell you how to trade. That's up to everybody to make a decision for themselves. All I'm here to do is try to offer up some education on how I trade and what has worked for me, and to potentially give you some information that you can potentially use to make your own trading, your own style even better, even more successful. All right? You can't go wrong with learning how to technically analyze intraday charts, learning how to analyze longer term charts. So that's a really good point that I want to close on today, guys. So everything that I just showed you, this is a 1 minute chart, right? This is intraday, this is for day trading, this is for scalping. You can use exactly this same type of analysis for swing trades, for investments. You can look at a weekly, you can look at a daily, you can look at a yearly. You're going to find these exact same scenarios on those charts as well. You're going to have channels, you're going to have support, resistance, you're going to have divergences in the volume versus your price bars, right? All these things you can use to be a better swing trader, to be a better scalper, to be a better day trader. It's just up to you to put in the work and to also start to, figure out the game, right? Because that's what's going to separate us from the other retail traders who don't quite make it. So guys, I really hope you enjoyed this video today. As always, if you like the content, please like, subscribe, and don't forget, you can absolutely join our Discord channel. It is free, and you can trade live with me every single day. All right, guys, take it easy. I'm out.